Hello everybody, as promised, this is part 2 of our webinar, Day Trading Without Charts. First thing we're going to look at is reversals and pullback points. Now, I'm personally not a huge fan of trading reversals. I prefer to trade second entries, which for me is trying to get in on the first retracement after a reversal. So let's talk in terms of a short to long reversal and presume that the same thing happens in a long to short reversal. Now, one thing I do think that charts are quite useful for is measured moves. So if on the way down we've been pushing down 10 ticks with average 7 tick retracements, then it's very common to do exactly the same on the way back up. And it's just a kind of measure of volatility. So we could say with trend swings are 10 ticks and counter trend swings are 7 ticks. Now that will vary day to day, but then we all know volatility does vary day to day. Now what will often happen is the first push up off the low is going to exceed the with trend swing size, and that's one of the things that actually tells you it's a real reversal. But the first retracement usually honors your counter trend swing size. Now with that in mind, I still give the volume profile more weight than the swing sizes when it comes to pullbacks. Now reversals usually do have an area of high volume at the low. Now sometimes this is excessive volume because the bidders absorb the selling as we got to the low. They don't necessarily hold the market to the tick, and so you often see a poke down through the high volume area at the bottom like this. Now, thicker markets like US Treasuries will very often hold to the tick. So as soon as you see that absorption, it'll hold the market there simply because it's a much thicker market, and that's the way they work. Thinner markets like crude oil and gold will be less inclined to hold through the tick and you will see more of a push down through the high volume. Now volume is usually going to be above average in the reversal, even if it's not excessive, and that's simply for the reason that it's come down and gone back over the same area twice. Now excessive volume is a much stronger sign of a reversal than just a bit above average volume, and this is where we go back to what we talked about in the first webinar, is you can see when it's excessive because you see, like in this case, you'll see the huge step on the volume profile.